I'm Jeremy, and our next panel is exploring the risk reward of the DeFi wilderness. DeFi is one of the hottest segments of crypto. Every day, new protocols are being created that offer novel approaches to value transfer and generate healthy returns. But these yields can come with considerable risk. Today, we are joined by Danielle Wall-Elliott and Patrick Horseman. Let's start with introductions. I'll hand it over to Danielle first.
Hi, everyone. Thanks for joining today. This is my second panel here, and I'm really excited to make some new contacts. As Jeremy said, I'm Danielle Wall-Elliott. You can find me on Twitter or LinkedIn on Twitter at Danny Wall. I have spent 6 years at Shapeshift doing operations and treasury management, as well as organizing a token launch and turning that company from a centralized company into a DAO. Shapeshift was a crypto exchange turned DeFi aggregator platform, and at the end of last year ceased all centralized operations, paid out its investors with the crypto that it had appreciated on its balance sheet, and turned everything over to the Fox holders and created a DAO. I coordinated the launch of the Treasury Management and Diversification Committee to help them diversify out of just $100 million of Fox and into different protocols and DAO to DAO collaborations. I currently am the COO at Names. We are building an on-chain insurance marketplace. We want to innovate on the Lloyd's of London model. We enable investors, brokers, insurers, and insureds to conduct their affairs in crypto natively, from capital to premium claims. We'll be launching fully in July, and we'll be fully regulated in Bermuda. So we'll be able to work with accredited investors. I am super passionate about returning power back to individuals and taking that away from corporations, banks, and governments. Really passionate about DeFi in general and decentralization. So happy to be here and happy to answer any questions.
Thank you. How about you, Patrick?
Hi, everyone. Thanks for joining. Happy to be here. My background is 20 years plus of hedge funds and private equity. Right out of college, I started a placement agent business called Blue Sand Securities with a partner. And we grew that business to 20 people, ended up raising about 15 billion for our various hedge fund clients over the next 10 years. And then in 2010, I co-founded my first hedge fund, Marion Capital, with 2 partners, raised 1.2 billion for that. It was a litigation finance strategy focused in an area called appraisal rights. Concurrent to that, but a few years later, I co-founded another private equity fund called Integrated Ag, investing in agriculture from a water rights and water infrastructure lens. And that from that business was my first blockchain business, Verified Organic. We put organic farming from seed to sale on the Ethereum blockchain in partnership with Consensus. Also in 17, co-founded the first equity blockchain ETF on the New York Stock Exchange, KOIN, with some partners from Millennium. And in 19, launched my first crypto hedge fund, Esoteric, which was focused on arbitraging the grayscale publicly traded trusts, GBTC and ETHE. And then in February of 21, my current venture is Coral Capital, founded with David Damdar, who's one of the founders of Galaxy Digital, and Tom McLaughlin, who has a background as an investment banker and a crypto miner. And that team's now grown to 8 people. We're running about 100 million, based in San Juan, Puerto Rico.
Awesome. Very impressive from both of you guys. I am looking forward, as I'm sure the audience is, to learning a lot today. So let's dig in. So my very first question to both of you, is the risk still worth the reward?
Yes, of course. I think that I love this. My dad has always took me to comic book conventions growing up, and Spider-Man says, with great power comes great responsibility, and I take that to heart with crypto and with DeFi as well. It is easy to get liquidated. It is easy to trade too much. It's easy to lose your keys or get scammed. What it is hard to do is to research, like the last panelist was on said, it is hard to research. It's hard to stick to your strategies that you have at hand. And you need to remain convicted, maintain custody of your own funds as much as you can. And yeah, I think if you're out there looking for a get rich quick or something that's too good to be true, it probably is. So go with your gut on those types of things. But if you have a good savings in cold storage that you've kind of put away, and now you've got some more crypto that you're ready to play with and invest in and get into this space, then yeah, the risk is worth the reward, in my opinion.
I definitely agree with that as well. From our lens, running a hedge fund, we actually view DeFi as one of the first times where you actually have a lot of tools at your disposal to manage risk. Historically, crypto hedge funds looked more like venture capital funds. They were buying tokens, they were long only, they were very volatile. And with the tools and platforms that have arisen in DeFi, you've got a lot of different levers to pull to manage your risk. The strategies that we manage, we run either market neutral or low net exposure. And that really wasn't something that was possible 4 or 5 years ago.
Okay. So I was doing some research for our panel, and according to the website CryptoSec, there's been over $1 billion hacked in value in just 2022. The Ronin network was 625 million in March, and then Wormhole with 326 million in February are just two of the bigger attacks. Why are there so many hacks?
It's really an industry where you're not even investing in crypto, you're investing in nascent software. And a lot of these platforms, they rush them out, they're not ready for prime time. And although there are software audits, sometimes they haven't been done when people start investing in them. The approach that we've taken is we actually have 3 internal developers on our team, and we go and perform our own audits before investing in things. And knock on wood, we've been able to, in the year and a half we've been investing, haven't been in any hacks. Not to say that won't happen in the future, just because it's kind of a cost of doing business. But the way that we approach kind of that smart contract and exploit risk is through diversification. You really can't be too concentrated, because if something does get hacked and you've got a big position, you're going to lose the money. So we like to invest across 5, 6 different blockchains, 25 to 30 different protocols, and kind of pay that insurance kind of premium through diversification.
Yeah, and I'll add, why are there so many hacks? It's because crypto is irreversible. And so it's a honeypot. If I can, I think the one that was like the 600 million was about access to private keys.
Right.
It comes back to that: with great power comes great responsibility. Like these honeypots are going to attract the bad actors. And so that's risk is going to be out there. It's not going to go away. And I think things you can do to protect yourself, if you're not using like a hedge fund manager or someone else who's doing the research, is doing the research yourself. And do they have a public team, someone that's willing to put their name on it? Do they have a smart contract audit available? And I think one other point I want to bring up is this idea of DAOs. So DeFi is decentralized finance, decentralized Wall Street, whatever you want to call it. DAOs are decentralized Silicon Valley. And you can actually go into these protocols, Discords. You can go in and listen to their meetings. You can go in and hear what they're doing. And so I feel like, we've pulled the curtain back, and it's more transparent now. And so if you are, wanting to invest in a company, or a DAO or any project, go find their Discord, go dig in deep, see if you trust the people that are actually, doing the work. I think that's really important.
So yeah, what you're saying is like decentralized expertise. I'm sorry, Patrick, I cut you off. What were you going to say?
So one other point I wanted to mention on the hacks is, a lot of people think of hacks as like someone gets your password or someone gets the keys and goes and steals all the crypto. That does happen. But particularly in DeFi, what we see with a lot of these hacks and exploits is it's really more of a multi-step arbitrage, where they're changing the value of a certain asset to change the value of a certain pool, and then they can go drain that pool and buy tokens that are worth a lot more at a very low price. I remember one specific hack last year, and the hacker had like 29 steps in order to make this arbitrage occur. And like, dude, if you can figure out a 29-step arbitrage and pull it off, like, all the power to you. That's crazy.
Some great minds, to be honest. I mean, because it's kind of like, on one hand, there's a lot of hacks, but in general, it's improving security, because it's like it's being battle tested in real time, and it's kind of this cat and mouse game, right?
Yep.
And we're finding with the smart contract audits right now, that they're out 6, 8, 12 months. Some of these, the best in the business, are so booked out. And so, if you're a crypto project and you want to do it the right way, well, you need to wait. But a lot of these people, they'll rush through the process. They might not get the proper audits. And so you really do need to see, how long has a project been around? Do they publish their, audits? Or are they really showing that they've done the work themselves?
So the other type of hack that happens is also just kind of liquidity driven. And there's a lot of rug pulls and situations where a project looks really good, a lot of retail money comes in, and then the founders who might be an anonymous team just drain all the liquidity. So it's sometimes not even a hack. It's just the ability for the project to go in and pull liquidity from a pool or a new investment. And you really have to be aware of that and understand kind of who's behind it and what the levers are as the team's tokens locked up, all that kind of stuff. So there's a lot of different considerations that go into looking at this area and kind of protecting your downside.
Just so everybody understands, can you explain in layman terms a rug pull?
So a rug pull, a good example, someone launches a new token, they go raise, say, $50 million, that's sitting in a liquidity pool, and the team has a lot of an outsized position in those tokens. And the way these liquidity pool work typically there's a stable coin versus whatever the project token is, and it's in equal amounts. And the way that these decentralized exchanges work, the pool has to stay in balance. So every time someone buys one asset, they're selling a bit more of the other asset to rebalance. So they're always at 50-50. And if the team controls a huge amount of the tokens, they can come in and sell their token and basically take all the stable coins in like 1 or 2 trades. And that can happen almost instantaneously. And if you have a team that's anonymous or a team that's untrustworthy or a team where their tokens aren't structured in a proper lockup, that can happen and does happen on a pretty regular basis.
Let's do one more definition. What's a liquidity pool? I want to make sure everybody has a good understanding.
Sure. So a liquidity pool, a good way to think about it is everyone's probably familiar with trading on Coinbase. There's maybe 300 different crypto pairs you can buy and sell. A liquidity pool is basically a decentralized exchange where you don't have a centralized entity like Coinbase or like the New York Stock Exchange kind of in the middle conducting the trades. It's a piece of software online that allows you to connect your Web3 wallet and you can buy and sell different crypto tokens. And as I mentioned previously, the way these liquidity pools are typically set up is there'll be 50% of one asset and 50% of a stable coin. And you can basically buy and sell the stable coin or the risk asset, and they keep them in balance at 50-50. So it's basically just a way to trade crypto on a decentralized exchange where there's no trusted party in the middle. It's a software platform like Uniswap or SushiSwap or 100 others that are kind of offering this service.
Okay.
And so for me, the whole reason why DeFi is able to give us these lending, yield farming, a lot of the programmable money that we see with Ethereum is because of this access to liquidity. And so, in the past, when it was centralized, when you're using an order book, when you don't have that guaranteed liquidity, you can't make it, so quick. You can't have the programmable money work without these pools. And so that really is what sets DeFi up for success.
So have both of you guys, we're discussing risk right now. Patrick, you mentioned you have developers. Have either of you guys, like through developers or through DAOs, like skipped over a project and then you later on saw the rug pull? Like any great stories from that your due diligence allowed you to kind of avoid being, liquidated or scammed?
One that I can remember from last year was Badger, which was kind of a wrapped Bitcoin platform, and that ended up having some issues. And we had looked at that, passed on it. And I know there's definitely a couple others, but actually there was one that a friend asked me about a new project that was launching this morning, and I talked to one of our portfolio managers, and he's like, "This looks like a potential rug pull." So it probably happens on almost a daily basis, and I don't think we have a list of them, but
yeah,
it's the 80-20 rule. Crypto is such a good business model. Like hedge funds are such a good business model that it's attracting a lot of people who are kind of unsavory and don't have the best intentions, and you really need to be very careful because there's essentially no regulation and people are just throwing up tokens. And if you can't differentiate between a good and a bad project, that's a bad situation.
Right.
For me, I've been telling my friends, my family members, anyone that will listen really since 2014 to get into crypto. Dollar cost average in, buy Bitcoin, buy Ethereum, whatever it is. I can just get these blue chip assets. They don't do it. They don't do it. They don't do it. Years later, they come back to me and they're like, "Oh, I bought all this SHIB and now it's worth whatever." Or Elon Musk tweeted about Dogecoin and it's going to go to $1. So I put in $1,000 or I put in $10,000. And then they're mad at me because I recommended they get into crypto. It's
right.
Yeah, but not in the way, not the meme coins, not the get rich quick. There is a strategy to this and it really, if you are looking, again, I'll go back to the get rich quick. It's not going to happen. Maybe you get lucky, but likely, you should just implement a better strategy long
It's
term.
a lottery ticket. That's basically what those are, lottery tickets.
Yeah.
Just new lotto tickets. So, all right, to round out this section on risk and put a pin in things, what are some of the strategies for monitoring and managing the risk in DeFi if you guys haven't already covered it?
So in our structure, we actually have hired a chief risk officer. It's someone that used to work at SEC and Fortress, number of big hedge funds, a big global macro hedge fund. And he's been a risk manager, managing multi-billion-dollar portfolios. So we have him sitting there monitoring the portfolio on a daily basis. And then from a software side, there really wasn't a trading platform or monitoring platform that really captured everything. DE Bank and Zapper are some of the kind of blockchain explorers within DeFi that will pull your positions when you connect your wallet, but none of them capture the full picture. So we're actually building internally a system that can go in through APIs and pull everything together, and we'll be able to see second by second risk of the portfolio. But that's something that currently doesn't really exist. We're having to develop that ourselves internally. And then the final thing is just going back to having a team that, rather than just looking at the pretty user interface in the front end and connecting their wallet, can actually go in and dig in on the smart contracts and read the code and understand what's actually going on under the hood and what the potential risks are, and are there any backdoors.
Yeah, and the tools that I use, and exactly what you're saying, Patrick, is there's not one that's going to tell you how risky something is, but there are tools out there to tell you kind of what are the best rates, what are the best yields. So Zapper is one, a huge one that I use. Loan Scan is an aggregator that will allow you to look for like the best lending rates. So like you can, move things around. They'll have rates for Compound, DYDX, Aave, Maker, Yearn, etc. DeFi Llama is another project that will kind of look across the board and look at the lending rates, yields, insurance, staking. It kind of gives you a full picture. And I think that at least helps me to know, like, oh, look, that looks like a new project that I haven't checked out yet. Wow, they have super high rates. Maybe I'll stay away from that one for 6 to 12 months until some other people have tried it out. Crypto Twitter is a crazy place, but that's where people are definitely talking and sharing their experiences, sharing if they've gotten hacked, rug pulled, whatever. So keeping up with like that pulse, like the daily regular monitoring. And then, yeah, I think one other thing I want to mention in this, Patrick said, diversification is a great protection against risk. And so one of the ways that I like to do that is Index Co-op has a token called the DeFi Pulse Index. Nice. So that you can have one token that can give you exposure. I think it's about 10 different DeFi platforms. That to me kind of makes me feel better. It's like they're evaluating, they're taking the top protocols and putting them in this basket. And that gives me that exposure that I want without having to keep up with every single thing and every single platform.
Okay. So I think we've done a good job of talking about risk. Let's talk about some of the tactical aspects and how people can earn yields. That's what people are here for. They want to learn how to make money. Obviously, they want to protect themselves first, but then they want to learn how to make money. So what are some of the strategies for investing in DeFi? Can you both cover what has worked well for you guys?
Sure. Two of the most basic ones, I'll just kind of explain them a little bit. One are liquidity pools, and the way that actually those platforms work, unlike Coinbase or the New York Stock Exchange, which have gone and raised capital from investors, have a balance sheet, the DeFi business model has been to look to third parties and essentially investors to put their tokens and stake their tokens, deposit the tokens into those liquidity pools, and basically build both sides of that balance sheet. So if it's an Ethereum versus USDC pool, investors would put in equal amounts of both of those assets. And in exchange for doing that, the decentralized platform, which is charging a commission on every trade, will share a portion of the commission with the investors that have posted the tokens for the period that they're actually participating in the pool. And this is not like a certain time frame. You can stay in for a week, you can stay in for a month, you can stay in for a year, as long as you want to keep investing. But basically, you can pull your tokens out at any time. And then in addition, there's many different decentralized exchanges. They're all competing for your liquidity. So what a lot of them will do is, beyond just giving you a portion of the fees that they're earning on the trades in that pool, they'll incentivize you to pick their platform versus a competitor by providing you an additional amount of yield in generally their platform token or their governance token. And the yields, as many of you know, can be pretty exciting: 30, 40, 50, 100, 1,000%. I would be wary of the 1,000% or 3-digit percent pools. There tends to be more risk in those. But oftentimes in new platforms that are very legitimate in the early stages, when there's not a lot of liquidity, you can actually enjoy really ridiculous APYs for maybe a month or a week, or depending on how fast the platform kind of gets discovered and how fast liquidity comes in. The second kind of major strategy in DeFi.
Patrick, can I ask you a question on that? Sorry, it
Sure.
might be unorthodox, but how do you guys think about impermanent loss, and how would you recommend people think about that when they are trying to put up for the liquidity pools and they need to convert to the 50-50 different assets?
That's something we think a lot about, and we don't like to take directional risk. In our flagship fund, about 75% of the portfolio is in stablecoins. So we participate in a lot of stablecoin pools. We're pretty active in Curve. And in those, when you have two kind of non-risk assets, two stablecoins, you don't have impermanent loss. And I'll explain what impermanent loss is for those that may not understand. So when you have those two assets in equal amounts that you contribute to a pool, say USDC and Ethereum, if Ethereum runs up a lot, they're having to sell USDC, sell Ethereum and buy more USDC to keep the pool at that 50-50 weighting. And what can happen, say Ethereum runs up 100%, and 2 weeks later you withdraw, you get back more USDC, but you get back less Ethereum tokens. And the math behind it is if the risk asset runs up about 100%, you're essentially losing about 6% of your total investment. So over time, the theory is you'll make that back in the yield that you're earning from the pool. But if you have to withdraw before you've earned enough yield, you will actually have a loss. So we try to stay away from impermanent loss. We don't do as many double-sided pools with a risk asset and a stablecoin. We like to do pools just with stablecoins in the bulk of the portfolio. And at the moment, there's kind of an imbalance between the amount of stablecoins in the crypto ecosystem and kind of the crypto wealth, which is around 2 trillion at the moment. There's only about 150 billion of stablecoins. So essentially, we can put up pretty interesting returns just dealing with stable assets that don't have this impermanent loss risk. When we do need to take some impermanent loss, oftentimes we'll do what I was going to explain in the second major trade in DeFi, which is collateralized lending, where we can post some assets to a lending platform and say we want to go in a pool that we need Ethereum as one side of the trade. We can post a bunch of our USDC, we can borrow Ethereum from that platform. So essentially we're creating a short position in Ethereum and then we go long in the pool. So we're balancing out that Ethereum risk and we're going to get back enough Ethereum to cover that loan. So that's one of the strategies we use is either borrowing the risk asset and essentially creating a hedged position on the risk side of the pool, or just staying away from double-sided pools. There are some single-sided pools and there's also stablecoin pools. So the second strategy that's a major one, I kind of ran through it a little bit, is just collateralized lending, where an investor, say they have 10 million of Bitcoin, they go to their banker at JP Morgan and it's like, I'm really happy you've got 10 million of Bitcoin, but I can't lend against that collateral. There are DeFi platforms, Compound, Aave, a number of others that have propped up to basically meet that need. It's essentially banking for the crypto ecosystem, where someone can deposit their Ethereum, Bitcoin, dozens of other tokens, and then take out essentially a loan against that, a collateralized loan. And generally these are like 50% LTV type loans with very tight kind of margin requirements. If the collateral you posted goes down in value, you either get liquidated or you have to post more collateral. And there's no broker calling you up on the phone. This is something you just have to monitor yourself. But in those situations, you can earn a yield, essentially lending out tokens to other people that are putting up crypto collateral. And one of the things that we've been really excited about is since we launched our fund, there's been two kind of market events where Bitcoin and Ethereum have drawn down over 50%, May and June of last year, and then the early part of this year. And through those really volatile markets and big 50% plus price swings in crypto asset prices, we as lenders on those collateralized lending platforms didn't experience any losses. The platforms worked, people were liquidated, they added more collateral, and the system actually works. It tends to be when human involvement comes in and they're favoring certain customers or not answering the phones that things get gummed up in these big Wall Street swings. But these are smart contracts. They just execute and liquidate people. And so far they've worked really well, which is very exciting.
Okay, so Danny, you're with Names, insurance-linked smart contract platform. What exactly is that? Can you kind of give us a quick definition of what they are, how that works?
Yeah, so we want to be a marketplace. We are building the network of smart contracts that will connect the brokers, the underwriters, and the capital providers together. The capital will come in and will be tokenized. And so then that allows people to actually be able to trade in and out of these positions, which is not as easy in the traditional marketplace. One of the first iterations of this will be like a crypto miner insurance company. And so we're in the world more of like reinsurance. We're not as much doing like direct insurance on your one specific, DeFi investment. So, say this Bitcoin miner insurance company wants to come on and they want to be able to write 500 Bitcoin worth of risk. We'll hopefully have, this market, people can come in, put up the Bitcoin, wrap Bitcoin because we'll be on the Ethereum network, and then they can start writing the policies on there. The premium payments will come in the wrap Bitcoin as well, and that will go to those capital providers. And one of the big draws for the reinsurance space and the insurance marketplace, and like, why would you want to provide capital there when you could possibly use that capital to go get 50%, APY, is because it's uncorrelated to the rest of the marketplace. Nice. So that's what interested me to join Names and to understand what it was exactly what they were doing. There's all this crazy returns and yield in DeFi, but this one is a little bit more, I don't want to say secured, but yeah, uncorrelated to the rest of the market. So our goal is to just take this 300-year insurance industry and put some innovation to it. It allows for less fees to the users because there's less need to have all the services provided by the underwriters and the brokers. A lot of it will be transparent in that smart contract. So yeah, we are working on this whole new marketplace. Hopefully, we'll be launching in July. So still working through all of the kinks, but being regulated is a huge piece for us. There's a ton of these insurance platforms out there that are decentralized, but they can't pass KYC. And so when we're working with these large reinsurance places, Munich Re, the Swiss Re's of the world, they want to work with regulated businesses. So that's why we're going through all the struggles of getting the licenses. Bermuda is quite friendly to digital asset businesses, like Circle is regulated there for their yield products. So that's been really helpful to us. And yeah, we want to grow this to be not just crypto insurance, but our first year will be fully collateralized, crypto native. But we see a future where people could write hurricane cover, people could write car insurance cover, nice. And find that capital in crypto, or stablecoins, whatever it is, on our marketplace.
So yeah, the market is the sector is just innovating. It's great.
Well, and
oh, I'm sorry.
Go ahead, Patrick.
I was just going to add to that, Danielle, that from a DeFi perspective, insurance is one of the areas we're very interested in. Still really nascent. There's been a few offerings that really haven't kind of met the needs of the industry, and it's exciting to hear what you guys are doing. And there's a huge need there, and I think a huge opportunity. Yeah,
and I had some examples to write down, like when I was looking at Fireblocks, which is a centralized, wallet custodian, half custodian platform. They only offer, $50 million worth of insurance, but that's for every person that has, their funds custodied by Fireblocks. So that's a drop in the bucket. I talked with the SFOX guys at Bitcoin 2022 in Miami, and they have insurance for $200 million for their whole ecosystem, which is great. But those custody solutions are risky because one, it's dollar denominated. So if Bitcoin runs up on a crazy tear and then there's the hack, you're really only getting that dollar value of the 200 million. So we really do need the insurance industry to get on board with crypto specific cover. And so hopefully, us having this marketplace and the smart contracts to do it, they'll start to buy in. And I love the tweets that are like, all companies will be crypto companies eventually. But it's still that uphill battle. And then I think once we can prove that like people can make money, using our marketplace, then everybody else will come in.
Okay. What do you guys see as the next wave of opportunities in DeFi? I mean, insurance is definitely one. What are some of the other ones?
think the lending space, rather than these over collateralized loans, which are fine if you just want to hold on to your Bitcoin, but if you actually want a real loan and need to borrow money, are not really doing much for you. So uncollateralized lending, there's starting to be some platforms offering that. People are trying to figure out credit scores, using actually Web3 activity. I think there's a way to go on that. It seems pretty risky to me. And then one I'm really personally excited about is kind of mortgages and refinancings and HELOCs. The mortgage industry is one that really hasn't innovated much in the last 20 years. It takes 3 months to get a mortgage. I don't think there's a good reason for that. So whoever figures out kind of DeFi mortgages, both using crypto collateral and then just really offering kind of traditional borrowers a streamlined product with a lot less kind of just bullshit in the middle, I think is going to do really well. And that's something we're looking to invest in and potentially to help develop a platform in that area ourselves.
Okay.
For me, Thorchain is the most underrated project in crypto. What Thorchain is doing is offering native cross-chain swaps, so decentralized exchange where you could actually trade Bitcoin, not wrapped assets, Bitcoin for Ethereum, for, they're connecting different networks. So the Cosmos ecosystem, Ethereum, they're also working on loans in the space that aren't over collateralized. So I think just seeing the progress that they're making in the cross-chain space, because it's like Game of Thrones. We're all fighting within each other. Which chain is going to win? I don't see any chain winning. I see them all winning. I see there being a layer built on top that will allow us to connect and talk through those chains. And so Thorchain to me is a place I'm constantly monitoring and looking what they're doing and what they're building next. And it is decentralized. Their team, does plan to fully hand over the keys as soon as they're done building, which I think is great as well.
Okay, so next we're going to talk about everybody's favorite topic, which is regulation. Can't talk about the industry maturing without covering it. So what do you guys think about President Biden's crypto executive order and what it means for DeFi from you guys' perspectives?
I thought it was overwhelmingly positive, and one of my favorite things in it was that they kind of addressed this point about the best projects all being offshore and all these American founders leaving to Asia and kind of markets that were more regulatory, totally tolerant of crypto. And if they don't do something about that, like it's going to be a huge brain drain from the US. So I think they made kind of the right kind of indications. Let's see what they start doing. The SEC seems kind of hell-bent on like being a problem for the industry, and I think that's disappointing. I think if there was just some clear regulations and guidelines, people would be happy to adhere to them. But the problem is, like, even Coinbase can't get a straight answer from the SEC on a lot of issues. So this kind of regulatory turmoil is not good for the industry. And I think it would be great if we get this issue kind of more streamlined and have some guide rails and some rules, and let's get in line and do the right thing.
Yeah, and I'll share just my experience with regulators in the US. Like Shapeshift was doing $50-75 million volume days when we could interact with our customers without KYC. As soon as we had to implement KYC, that business went off to $1,000 volume days. It completely gutted us because it went against our ethos. It went against, who we were and what we wanted to achieve. And so when we were able to integrate projects like Thorchain, like 0x, a DeFi aggregator, it saved our business. It allowed us to tap back into who we wanted to be. And that's what really encouraged us to go the DAO route, was to get out from under all the regulatory burden. And so I think that's what we're seeing right now with the development of all these DAOs. They're finding their place, and they're doing it outside the regulation. They're doing it, they're innovating without permission, but now I'm back working for another regulated company because I really believe that, to bring the real traditional finance into our space, we need to do it in a way that is regulated and that their investors can get behind, and their, compliance, KYC, AML, all the things, it's up to snuff. And so working with the regulators in Bermuda recently, it is a breath of fresh air. They actually want to innovate with us, and they want us to get the licenses that we need to do what we want to do. So they have this program where you can get a sandbox license. It's kind of like your draft and you can tell them exactly what you want to do. They'll work with you. And so I think we'll see companies like Patrick said, like leaving the US, but still going and finding regulators and countries that are friendly to crypto. And there are some out there. And so, working with Bermuda and finding that niche that's like, we're explaining to them what smart contracts are and we're educating them and they're on board and they're willing to work with us. And I think that's where the future of regulation will be.
Okay,
I would echo that on Bermuda. I've actually been to a bunch of conferences recently where a number of the regulators are actually there from Bermuda. They're knowledgeable. The Bahamas is another good jurisdiction. FTX just moved there. So hopefully those companies at some point can be moving back to the US. But at this point, they're trying to find a friendly regulator that actually has set forth rules, which the US really hasn't done yet.
And that will talk to you. Exactly what you said.
Yep.
Coinbase is like asking for guidance and can't get it. But like I can talk to these, the BMA, I can talk to them on a regular basis and say, hey, this is what we want to do. What do you guys think about that? And they're really willing to like learn.
So Fitch Ratings believes that DeFi could split, kind of what you guys are also saying, into a regulated and unregulated segments. So how will this impact the sector? And also what opportunities will both regulated and unregulated create for investors?
I think kind of the crypto ethos is like, we've created our own money, no one's in control of us. And that kind of, I think, goes against the regulated kind of KYC model.
Right.
A lot of platforms may start prohibiting US investors. A lot of them already do. A lot of the Asian exchanges, you just can't trade on if you're a US person. As a hedge fund, you can do some structuring where you can set up a Cayman Islands fund and then you can interact with those platforms, but generally US individuals can't. So I think it's really going to bifurcate the industry. And going back to Danielle's point with Shapeshift, once they had to have a KYC regulated platform, like the business ground to a halt. So I think it's going to be a difficult transition. Not to say it's insurmountable, but it's kind of, let's wait and see how it goes. And my gut is that just given kind of the ethos of most people involved in crypto that don't want to be KYC and don't want to be regulated and want to be anonymous, it's going to be a difficult transition.
Yeah, well said. And I think like, what will happen first is this like wave of innovation outside the regulation, and then regulated businesses will try to do what they've done. And we see that with things like the yield and yeah, Coinbase offering some of these things that are happening in DeFi and trying to figure out ways to offer it, to their regulated customers. So I think, I'm happy that there's these people that are willing to take these risks and do the unregulated businesses first and innovate, because then that helps the regulated businesses to kind of like learn from it and implement it for their customers as well.
Okay, so next I'm going to go into something that's controversial and complex. I'm eager to hear about you guys' viewpoints. So as we're seeing more and more countries are embracing crypto and blockchain, but both of you guys keep mentioning Asia in this conversation. So the elephant in the room is China's CBDC. And do you guys think that the US will go the stablecoin backed route? Or what are your thoughts on China's CBDC, America getting one or creating its own, or are stablecoins kind of the way we will approach it in the future? No, it's a very long question, but eager to hear your thoughts.
Yeah, I think in China, they really love to control people and monitor people. So this is a great way for them to do that, and kind of banning crypto and then bringing in a CBDC themselves gives them kind of back a bunch of that control. Mm-hmm. The way that I've heard it explained to me by some people much smarter than me on the topic is that if you essentially put out a US CBDC, you'd almost put the US banking system out of business. Right. Because you'd have a digital ledger directly from the government. Like, why do you then need JP Morgan or Bank of America to hold your money? You've got it in your own wallet. So in the US, the CBDC is much more likely to be at the kind of the treasury level and amongst the banks rather than interacting directly with consumers. Mm-hmm. And for the time being, private stablecoin issuers like Circle, Tether obviously has some controversy around it. There's now algorithmic stablecoins that are backed by crypto rather than dollars. And it seems like the one thing the US regulators are really focused on at the moment is stablecoins. And I think there's a high likelihood that stablecoin issuers like Circle at least US issued ones, are going to be regulated as banks. And that may not be the worst thing. It'll probably bring down the returns for their shareholders and equity holders a little bit, because there'll be much tighter restrictions on what they can invest in and earn a float on. But it's probably a good thing for the crypto ecosystem to have them actually be regulated, and all the users to know that those reserves are actually there.
I'm fearful of any governments or trying to create a stablecoin, because I'm like, how will it be to the ethos of crypto? Will they kind of pervert what we actually want? And so I'm always fearful of that. I think even hearing Facebook Metaverse talking about oh, they're going to implement these like pay to play games, implement oh, you can buy the little avatar shirts and things, but then they'll take 50%. So I think when I hear of any governments, corporations, banks trying to do their own crypto or stable coins, it's like, nah, it almost sounds like they're just trying to use the buzzwords and then do something else that they want to do. But innovate or die. So hopefully maybe they will tap into some of the things that we're doing, and some of the citizens can get benefits from that. But I'm always wary of any government stable coins.
The thing that scares me the most about the China one is they talk about like expirable money, like they can send you a stimulus and say if you don't use it by 60 days, the money can like disappear.
Yep.
Yeah, that's like absolutely the opposite.
No, and even with the existing privately issued stable coins, the governments can come in and request that like a certain address gets their coins frozen, and essentially you thought you had all this money sitting in your crypto account and it's essentially frozen. You can't do anything with it. And that's happened both with Tether, USDC, and others. So it's kind of getting back to the whole crypto ethos of people being in control of their own destiny and not having a central party in the middle. The government wants to take that control back and have an on and off switch for your money. And they already do with your current bank account. They can just freeze your account, but Bitcoin and Ethereum being decentralized, they can't turn that off. But with the stable coins, you do have that risk of some regulator coming in or the government coming in and essentially freezing your stable coins.
So do you guys think the other countries are going to go more the US and this open direction, or more like China's direction?
I struggle with that, because I see us going to a more global economy. So my company at Names, like we have 15 employees in 10 different countries. It's like it's almost like a step backwards to try to think like, oh, a passport for every single country. Oh, a stable coin for every single country. Like that scares me. I want to think about how we have this global economy, how we can work with people where we don't care about where they're from. So yeah, it doesn't interest me as much, but I'm sure they're going to try to do it.
Yeah, one of the most exciting things about DeFi is it's removing friction from financial transactions, reducing costs, and kind of getting rid of these monopolistic banks and other exchanges in the middle that are taking these fat fees. And like, why do you need to send a wire between 9 a.m. and 4 p.m. on a weekday? Right. With DeFi, you can send USDC to your friend at 2 a.m. on a Saturday night, or you can take out a loan from a platform. So the government kind of creeping back in and adding regulation is going to, I think, impact that freeness that these systems are so exciting for.
Great. So I think we've covered regulation. So let's talk about the future. From both of you guys' perspectives, what are the most exciting areas from the venture capital perspective? So
looking at kind of tokenomic models for DeFi, DeFi 1.0 was this liquidity pool concept where investors would deposit tokens and they would earn a yield. The problem with that is it became a situation where they were offering a really attractive yield for 6 months, and then the treasury ran out, and then all that essential liquidity would actually move on to the next opportunity. So it became very mercenary, and it really wasn't doing the projects a lot of good. So DeFi 2.0 introduced more of a bond-like model where investors essentially bought a bond, and then there's a secondary market for trading those bonds, and that's worked a little bit better. And we're now almost on the advent of a third kind of DeFi 3.0 tokenomic model where a big part of controlling these platforms is the voting of the governance tokens that you get for participating in the platform. And there's this new model called vote escrow, where essentially if you lock up your tokens, rather than having one vote, you might have 3 votes. And that has the added benefit of kind of decreasing the selling pressure on the token because people have locked up their tokens for longer periods. So that's something that we're seeing a lot of projects implementing right now. And I think that's going to be an exciting area to focus on and invest in. Obviously, play to earn gaming, blockchain enabled gaming is a really hot sector. I think you need to be careful there. There's a lot of hype and kind of crazy valuations, but finding the right projects at the right valuations is an exciting space. DeFi protocols continue to innovate in the insurance space, the lending space. That's a big area of focus for us. And then just general digital asset infrastructure broadly. There's a lot of kind of big building blocks that still need to be built for the industry that I think are kind of going to be the institutional players of the space 5 years from now. And those companies are still being built right now. So finding those early on is exciting.
Yeah, and I think, for me, what really inspires me is when I'm in these DAOs or I'm observing the DAO to DAO collaboration. And I think in the past, when there's been partnerships between companies, usually they tack on fees and add fees and pass that to the user. And I think what you're finding in the DAO to DAO collaboration world is like they're putting up proposals on both sides. Both DAOs are paying for the work for the implementation, paying for the rewards for the community or for the users. But then they're just splitting the fees rather than adding any fees on top. So I think DAO to DAO collaborations in DAOs are actually investing in other DAOs. So they're diversifying their treasuries, which is totally necessary and smart. And so they're either using like an investment in another DAO, or maybe they're buying the token and locking it up, investing it. But we'll see all of these protocols become a little bit more intertwined in that way. And I think, again, going back to my point, like it's the decentralized Silicon Valley. Like, how often have you ever, you can't go sit in on the Twitter meetings. You can't see what they're working on. You can't see what's coming next. And so this idea of alpha in DAOs is amazing because you can see the proposals that are coming. You can see what work is going to come next. You can see, what is the new innovation. And I think it just being really transparent, that's super helpful in this world. And if you're an investor, you can go in and see the team and look ahead of time and see what's going to come next to say, okay, yeah, I do want to buy that token. And for me, buying tokens and participating in projects that actually interest you. I've stayed pretty much completely out of like the whole NFT game for a while until I found this NFT that I really liked and that I will actually use. I'm a foodie, so bam, I found a foodie NFT where they're gonna give me content for food and 2 chefs in the Discord that you can talk to and events that you can go to. So I think like staying true to like what interests you, that's where you're gonna find the most value. And so that like keep an eye on DAOs because 2022 is like the year of the DAO.
So both of you guys earlier in the webcast mentioned like auditors having a 6 to 8 month wait. Patrick, you talked about having to build like custom risk management tools, which both of these seem like great places for venture investment. The question I have, excuse me, are there enough skilled people to create these products? Like, what do y'all think from that perspective?
I think that's one of the most exciting things about the industry is we are attracting people from Goldman Sachs and from the top Silicon Valley firms and a ton of development talent. People are leaving amazing jobs to come work in crypto. So I don't think that's a big impediment. I think we'll continue to see that trend. And it's going to take time to build these platforms. I was at a really interesting conference in Switzerland in January called Crypto Finance Conference. And Gavin Woods, he was the CTO of Ethereum and then went on to build Polkadot, one of kind of the visionaries of the industry. And one of the questions they asked him at the end was kind of compare and contrast us to kind of the internet cycle. Where are we in comparison? He said, we're still in 1995. So the fact that it takes 7, 8, 9 steps to get your fiat into DeFi and actually interacting on these platforms, like that's going to have to change. I think another question people often ask is like, when are we going to see crypto really go mainstream? And my thesis on that is it's going to go mainstream when people don't know they're using crypto and don't know they're using blockchains. Companies like Square and PayPal and Venmo that are integrating crypto right into the apps that you're already using. That's just going to be over time a much more seamless experience. You're not going to need to have a separate wallet. It's going to be tied to your Google login. And as it gets easier and easier to use, then we're going to see much more adoption and the security getting better and everything getting better. But if you look at that internet 1995 analogy, there was a lot of hacks going on in the internet at that point too. So it's going to take time, but it's a very exciting time to be in the space.
All
Yeah,
right.
for that hiring piece, we used to hire people that had an interest in crypto. Now I hire experts in their field. I hire experts in marketing. I hire experts in that. We can teach them the crypto if they're interested and they want to learn. And I think that's, just Patrick, you're reminding me of that. It's like the industry is evolving to get experts in what they've already done in the past, rather than just like the cool kid who knew about crypto in 2015. And now he's your CTO. It's like, that's not happening anymore as much.
Yep.
So let's take it even more like real world and relevant. I've seen a lot of reports of how DeFi protocols and DAOs were being used in the Ukrainian-Russo war. Like, what do you guys think about that? Like, obviously that's a turning point or a touch point. Like, what innovations will come from that? Like, what are you guys seeing?
Well, we've seen like the Ukraine DAO established by like Pussy Riot and those people who are trying to raise money and raise funds and have this community that can then go and, allocate and help on the ground. I think that honestly, I get a little scared talking about it with the recent, Virgil being sentenced to 5 years helping North Korea, but it's not just Ukraine that can use crypto and get outside of what's happening to them. It's also Russian citizens, they're exiled from the banking system. Well, crypto is a great use case for them, and these DeFi platforms are a great use case for them. So I think we'll continue to see it in any conflict zones.
Yeah, I would echo that. One of the other things, like the president of Ukraine, like directly asking on Twitter for donations in crypto, just really legitimizes the space. Like, this is something that they can, with their banking system being shut down, this is a way for them to transact, and their suppliers and people they need to do business with are willing to transact in crypto. So I think it just shows kind of where the industry is going, that it's grown a lot, and this is a viable way to transact business.
Okay, so we got less than 10 minutes. What are some of the tools you guys suggest for our audience? Like, how can they be better informed? How can they be more relevant? How can they get better yields? What are some of the tools to help them do that?
So our team really digests a lot of information through crypto Twitter, through Discord, Telegram, and we're literally spending probably half our time reading and digesting information on new projects, because this industry moves so fast. With our fund administrator, Sadrania, we're probably showing them 10 new positions they've never seen before every month. So it's just a very fast moving space. And unless you're spending the time kind of keeping up to date on the existing projects and the new projects that are coming, you're just going to get left behind. A really good way to do that also, if you don't have the time to read 6 hours a day like we are, is start listening to some podcasts. Bankless is a great one for DeFi. Delphi Digital is a great one. There's a dozen others. But if you listen to 1 or 2 podcasts a week on the space, that'll at least kind of keep you current, keep you in the know.
Yeah, I'll add to that and say, go to a conference. I'm going to go to Permissionless. That's put on by the Bankless guys. It's supposed to be one of the first like truly DeFi conferences. And I always get so much information and so much inspiration. I think that's a key piece of it. It's like when I just kind of am like a Twitter person and reading it doesn't like sink in. But when I meet someone in person that's truly passionate about what they're doing, that helps kind of solidify it, and it makes me understand it more. And then, I'll just mention the tools that I mentioned again, if you guys didn't write it down, but like use aggregators. There's a lot of aggregators out there that are taking all the information from these platforms and putting it in one place. So LoanScan, DeFi Llama. I don't think I mentioned this one, but cryptofees.info is a big one that I like to keep an eye on. It just shows you, rather than like CoinMarketCap, which is showing you the price and the market cap, this one's showing you how much fees the users of the platform are actually earning. And so that's a really good one that I like to keep an eye on and watch who's earning the most.
Okay. All right. So what platform, you guys are experts, what platforms yourselves are you using to secure your wallets and keys?
I mean, definitely get a hardware wallet if you don't have one. If you have, the centralized services are necessary, but you should not be keeping a large amount of your wealth on those centralized services. That's going to protect you. I think that, Ledger is probably the top hardware wallet in the space and has a great integration with MetaMask, which will allow you to interact with most of these DeFi protocols and platforms. And yeah, keep your private keys safe, keep them backed up, keep them offline. Don't take a picture of them. Don't put them in your password manager. Like, this is the one place where you really, really should truly have this like paper copy, and secured however you best see fit.
Yeah, I would echo that definitely for kind of more individuals investing in crypto from kind of a hedge fund and institutional investor standpoint. You have to go beyond that and try to find a custodian that can really kind of provide the security you need. The big difference between crypto hedge funds in the past, which were really kind of trading Bitcoin, Ethereum, other kind of major coins long only, and could basically put them in cold storage and kind of take them offline to help secure them. In DeFi, everything's on chain. It's got to be live. And we're depositing these tokens across dozens of different platforms. So a couple of the tools and partners we've used, we started with Fireblocks last year. They're a great company. And if you're trading kind of the top 500 to 1,000 coins, they probably have you covered. If you're a little more kind of innovative and going after some of the more nascent things, they weren't able to allow us to invest in certain platforms and certain new blockchains. So we ended up transitioning to another group called Trustology, which is based in the UK. They were a spin out of Consensus, which is Joe Lubin's company, one of the founders of Ethereum, and helped design MetaMask. So it's a MetaMask-based tool, which most people in DeFi are familiar with. But behind that, they've built an app, they built a biometric interface where, and then you can set rules so that the certain members of the team can trade X amount of crypto per day, can move X amount of crypto. They need controls and approvals from other members of the team. So it's kind of looking at like an institutional equity trading desk, the controls you would have there, and then implementing that for the crypto industry. MetaMask Institutional is another similar version of that. So more and more of these tools are being developed. But if you're trading a significant amount of assets, you definitely want to look into something at that level.
Okay.
One other thing I'll recommend as well is if I'm interacting with a new smart contract or a new protocol, I'll use a fresh address and like a fresh wallet. And so I would never interact with like my cold storage, my life savings, and think, oh, I'm just going to buy $100 of this new token, because there could be something in that smart contract that could then drain the funds in your wallet. So if you are managing yourself and you have hardware wallets, definitely like new addresses, having some clean segregated accounts is definitely recommended.
Okay, we got 3 minutes left, and what I want to do is bridge this middle panel with the keynote we had before and the keynote we have after. So first question would be, how do you guys see DeFi interfacing with the metaverse? And then secondly, do you see DeFi ever interfacing with Bitcoin?
Well, I'll just want to start with the second one, and Patrick, you can take the other one, but it is interfacing with Bitcoin. Thorchain exists. Thorchain is a decentralized exchange where you can use, native Bitcoin. So it is already there. It is happening. And then of course you do have the wrapped assets like wrapped Bitcoin. And I think that that's a key piece to bridge those networks. And I do see a future, again, I've said this before, but again, where the chains will talk to each other and you could still operate on the native chains.
Yeah, I think on the Bitcoin question, wrapping Bitcoin, enabling it to be used as collateral across different chains, that is already happening. People developing the Lightning Network want to develop more kind of Bitcoin specific DeFi applications. I think that's coming. And as far as DeFi interacting with the metaverse, I think it's going to be a huge part of the whole development of that space. Play to earn gaming, in-game exchanges of tokens and game items. It kind of plays right into DeFi's background.
All right, so this has been great. We got 1 minute left. Why don't you guys tell people how they can contact both of y'all, and then we'll move on to the next presentation.
You can best reach me on LinkedIn or Twitter. And on Twitter, you can find me at Danny Wall with 3 underscores.
Coralcapital.io is our fund website, and I'm on LinkedIn and Twitter as well, Patrick Horseman.
Okay, this has been great. I appreciate all the time and knowledge you guys have given our audience. With that, I'm going to turn it over to Michael, and then we'll give it to Brian Estes I thank you again, and we look forward to having you both here again.
Thanks, Patrick.
Thanks, guys. Bye.